Okay, this is the first lecture video for investments. I try and keep my videos relatively short. I do cover most of what's in the chapter, but I try and keep each video 15 minutes or less if I can. So I'll break the chapter down into several videos for chapter 1 and continue to do so throughout the semester, just so you know. Okay, so the first thing we talk about in this chapter is the nature of investments, real versus financial investments. So investment, the purpose of investment in the first place is to reduce current consumption for greater future consumption. So effectively, we're trying to grow our money so that we can consume more later. And when you think about the most basic form of investment, that's what you're doing. You're trying to get a return so that you can spend that money on something else and consume goods with it later. There are two different types of assets that we're going to talk about. Real assets. Real assets are assets used to produce goods and services. Okay, so this would be mostly, but not wholly, tangible assets, whereas financial assets are more intangible. I say mostly because real assets does include things like knowledge that can be used to produce goods and services, which is really more like an intangible asset, but it also has land, buildings, equipment, those kinds of things in the real assets. So financial assets, on the other hand, are claims on real assets or the income generated by them. So we're talking about bonds, we're talking about stocks, we're talking about any type of security, and most likely are not more than just a piece of paper, okay, just a form of rights, effectively, for a financial asset. This is the U.S. household's balance sheet, which I found kind of interesting. It's from 2017, so it's a few years old, but it talks about the difference between our real assets versus our financial assets. So you see that in the United States in 2017, there was 28, I guess it'd be trillion, because it's in billions. So $28 trillion for the real assets, $107 trillion worth of financial assets. And then we had $15 trillion worth of liabilities. So where this net worth comes in is we're taking this total financial assets minus the liabilities. So net worth, another name for that if you're used to accounting class, would be equity. Okay, effectively, that is what your net worth is in this case. So they took the 107,910 minus the 15,104. You see it doesn't work out to the exact right number, but that's also there's rounding errors in this because they shorten the numbers quite a bit. So you see we're much heavier on the financial assets in the U.S. than we are on the real assets, which makes sense. Okay, financial assets and liabilities must balance, meaning the financial asset and the financial liability, or there's two sides to that coin. So you think about a share of stock, okay, a share of ownership stock in a company. The person who owns that share of stock, that's a financial asset to them. Person who, like the company itself, it's a liability. And really it's equity, so they use the word liability here, but they say liability because, you know, if that company goes under, if that company goes away, or if you have to buy that company out for some reason, it's a liability that you have to pay that owner in order to get it. An easier example probably to understand, if we all know what bonds are, is a bond. But when you buy a bond as an investor, you receive insurance payments and you receive the principal payment at the end. But it is to the person who issues it, the issuer of that bond, they owe interest over the time frame of that bond and then owe money at the end. So those two numbers should be equivalent. If I buy a bond, you know, it's an asset to me, which should be equal to the financial liability that is for the company that I bought it from. I believe the example the book gives is Toyota selling bonds. So the aggregated balance sheet, only real assets remain. Why do only real assets remain? Because like I just said, the assets should equal the total financial liabilities. So in the end, that wipes out and the real assets would be all that's left. And then the domestic net worth overall is the sum of all of the real assets. So you see this is, again, more tangible assets, which is what mostly our real assets are made up of tangible assets in the first place. All right, different types of financial assets. Common stock. Common stock is an ownership stake in entities and their residual cash flow. Okay, so money that they have made, that they retain, they can choose to pay, depending on the type of company, they can choose to pay dividends, or they can choose to pay draws. That's what stock would return. Derivative securities are contract values derived from underlying market conditions. So example of that is things like options. Okay, so you can buy an option, and an option works effectively. You say, I want to purchase an option to buy, let's say, I think the book uses Intel stock. So it says if they purchase, so a call option on a share of Intel stock might turn out to be worthless if Intel's share price remains below the threshold or exercise price as like $35 a share. So if you buy a call option and you effectively are buying the rights to purchase Intel stock for $35 a share, there's no value to that option until it reaches $35 a share. If you believe it's going to go higher than that, though, buying it before it reaches 35 can be, valuable. So then effectively what happens is once the stock reaches a price that you're willing to buy it at, you can exercise that call option and you can buy the stock for $35, even if the price is $40, $42, $50, whatever it is. Now, these generally also have a time frame, a given time frame with them most of the time, but that's a derivative security. And then there's fixed income securities, which includes things like money market instruments, bonds, which I talked about a little already, and preferred stock. I would think that in your prior classes you've studied those enough, but this is an example of a spot where if I'm running over something that you haven't seen before, feel free to, email me, message me, let me know. I can cover any of these areas individually more. Okay, the financial markets and the economy. The informational role of financial markets. The idea behind the financial markets in the first place is that it should show the company's prospects, and the companies with the best prospects should have the highest capital flow. So it's not just about current value, it's also about future value, and effectively overall it should at least resemble their fair value. So what you'll notice if you look at the stock market is that the market value, or the market capitalization is what it's called generally for the stock market, the market cap of an organization would not equal the equity section of the balance sheet if you look at their financial statements. And the reason for that is because wrapped up in that stock price, in that market cap, is not only the current value, but what the prospective value is of that organization, which is why they won't match up. Most of the time it's higher, but it can actually technically be lower if the company's really doing poorly. But generally speaking, you're talking about a number, the market cap is higher than the equity section of the balance sheet. Market capitalization, just so you know, is about the total aggregate value of all the shares of stock on the market. So if I go out and look at a stock price, go out and look at, no matter what stock price, go out and look at Apple, and then I multiply that by the number of shares outstanding, that would be the market cap, the market capitalization. Do markets allocate capital to its best use? It is supposed to. If it's a perfect market, we a lot of times assume an efficient market hypothesis, or that the market is acting efficiently. If it is acting efficiently, it should allocate capital to the right place. And stock prices play a major role in that, because stock prices going up or down shows prospective earnings and values. And if they're correct about the prospectus, then that would allocate capital correctly. And there are other systems. That's an area I'll skip over for now. You can look at those on your own. But there are disadvantages and advantages to other systems that work this way too. But this is the capitalist version of the system. Okay, consumption timing. Financial assets are often used as methods of choosing when to use that money for a consumable good. So that means it's oftentimes used to store wealth or grow wealth, and then we transfer the timing of that consumption to the future. So for example, saving for retirement. Okay, so I'm putting money into a retirement account, and I'm not consuming that money right now. It is in financial assets. And once I retire, when my income is lower than my need to consume, that is when I will start using that money for consumption. But right now, for me personally at my age, financial assets were used as a store of money, store of wealth, to push off that consumption timing to the future when I'm going to need it. And at that point, when I retire or when I need it, I will remove it and then use it and consume not the money, but consume the user goods that I buy with it. And you can see this changes generally over your age. So this would be the time frame when you're earning money and in an industry, and then here would be about retirement age. Down here would be when you're either not earning money or even in college or that type of area where you're not having much in the way of savings. So effectively, this horizontal line is the length of your, for most people, and this can be different for everyone, but generally speaking, I'd say that's the length of your career. And you can see age is my deciding factor down here. Okay, risk allocation. Risk allocation. Investors select desired risk levels, so bonds versus stock, for example. And even within bonds and stocks, there are different levels of risk. You know, penny stocks, small companies are generally higher levels of risk. Bonds, they rate bonds. Companies have credit scores just like individuals do. So, you know, the lower their credit score, the lower their bond score, the more risk involved in buying that bond. And then there's also things like bank CDs, and then there's corporate bonds and company bonds. The question here that it asks is there always a risk and expected return trade-off? The answer to that is, I don't like when they use the word always. There's always a relationship between the two, I would say. But the expected return, generally speaking, we're talking about the higher the risk, the higher the expected return. The lower the risk, the lower the expected return. So putting money in a savings account, which should have very low risk because you have FDIC insurance unless you're over a certain dollar amount, would return the least amount because there's very little risk to it. Whereas investing in a low quality, say a low a bond, someone that doesn't have a very good credit score would be high risk and would, you know, should return a greater return on your investment. So the higher the risk, the higher the expected return, the lower the risk, the lower the expected return. If you're expecting a low return and it's high risk, you probably shouldn't be in that investment. Okay. Financial markets and the economy. So something we need to understand about financial markets, and that's something we need to understand about how organizations are run, is that there needs to be a separation of some type between ownership and management. And the reason is because if there's not enough separation, then we can have agency problems. So an agency problem, to put it succinctly, and this is actually an area I'm studying for my doctorate right now, is when a manager makes decisions based on their own, what they want versus what is best for the owners. Okay, a manager should be acting on behalf of the owners at all times. But there are times when when managers can act on their own behalf rather than in the best interest of the owners. And that is what we would call an agency problem or an agency issue. Ways that we mitigate the agency problem: performance-based compensation. So the better the company does, the better that the manager gets paid. Usually is a pretty good motivator to, you know, reduce the agency issues. The fact that the board of directors can fire managers, you know, that ability helps mitigate that. And then the threat of takeovers itself can be a mitigating factor. Also, corporate governance, which is what we're going to talk about next, can also mitigate agency problems. So corporate governance and corporate ethics, business and markets require trust. If there is no trust, there's additional costly laws and regulations. So a good example of this is what happened after the accounting scandals, and we're going to talk about that on the next one here. But a lot of trust throughout that time frame was lost in the financial accounting system, and so they added a big law called Sarbanes-Oxley, which aided in adding regulation, which cost more money, but it renewed the trust in the financial industry and especially the accounting area. Governance and ethics failures not only cost the economy, but it also erodes public support and confidence. People are less likely to invest when they don't trust, you know, the companies they're investing in. Examples: Enron, WorldCom, Rite Aid. Those were the accounting scandals that happened right around 2000, late 90s, right around 2000, 2001, which Sarbanes-Oxley, the law Sarbanes-Oxley was passed in 2002. Misleading reports. The auditors are the ones that are responsible to be the watchdogs. They're supposed to be independent. Here's where it talks about Sarbanes-Oxley. Requires more independence, not just from the auditors, but also independent directors. Independence matters because it creates less bias. The more independent you are, the less biased you're likely to be. The CFO has to personally verify the financial statements, which puts them, if they're wrong or incorrect or there's a problem, it adds risk to them. They could be jail time or fines or other things. There's an oversight board for the accounting and audit industry that's called the Public Company Accounting Oversight Board, PCAOB. Well, everybody in the accounting world calls it peekaboo for some reason, even though it's PCAOB. And then charged board with maintaining a culture of high ethical standards. So from top to bottom, ethical standards should be pushed by the board of directors. I'm gonna stop this video here and I'll continue with the chapter in the next video.